Hello, I'm Amit Stavinsky. I'm the Managing Director of Tamar Securities. And so proudly so, also, two of our subsidiaries, Firefighters United and 911 Financial Services. I've been in this industry investing money for clients for the past 3 decades now. I'm very proud to work with all of our employees and our clients. I wanted to take this opportunity during these uncertain times to share with you all some of my thoughts of where we are at and where we are going from this point onward. Let me start by saying that last week, non-farm payroll increase of 194,000, in my opinion, was a disappointment. Prior months' numbers were up by 160 plus thousand, which means that the economy is now, on average, growing the employment non-farm payroll at a rate of 500,000 jobs per month. On the face of it, it looks good, but it doesn't take into account that we lost last month about 180,000 educational jobs. It doesn't take into account that 1.6 million people stopped looking for a job altogether. It doesn't take into account that the labor force is shrinking. In fact, the labor participation rate dropped to 61.6%. It doesn't take into account that there are over 11 million job openings, and more than 60% of all companies out there will tell you that they are unable to find qualified people to fill these positions. On top of everything, there are additional uncertainties such as inflation. The consumer price index is still running hot at 5.3% year over year. The producer price index is also running hot at north of 8%. This week we'll get the producer price index numbers. The expectations are that PPI numbers are going up by about 0.5% every month. We will get the CPI numbers this week that are expected to come out again at 5.3% increase in prices year over year. But that is if you believe in the government numbers, which I am not necessarily sure are correct. The government will tell you, the Federal Reserves will tell you, that these inflation numbers are transitory in nature. Most likely some are and some aren't. Labor shortages, and as a result of that, higher pay to employees is not going to go away, in my opinion. When we hear about real estate values going up 20% year over year, the cost of construction goes up, therefore rents most likely will go up. So that number of 5.3% increase in prices year over year and PPI numbers, producer price index numbers going up 6 to 8% year over year, doesn't necessarily, in my opinion, reflect the true increase in real estate values, because we know, for example, that the biggest component of the CPI numbers is rent, and rent is recorded going up only 2.6% year over year, and this is due most likely to the moratorium on evictions. And this is not the normal market environment that we operate in. Other uncertainties and risks that come to mind include the possibility that taxes will go up next year to help pay for additional social programs, such as the $3.5 trillion of social wealth care and $1 trillion of infrastructure bill that supposedly will be passed soon. To pay for these additional spendings, in addition to $3 trillion that was already spent last year and $2 trillion that was approved for spending this year, we are already, by the way, running at about 40% of the GDP in government spending alone, and the day will come that we will need to pay for it in the form of higher taxes. There is talk in Washington that the ordinary income taxes should go up from 37% to 39.6%. That is very much a possibility. But what is more concerning to me, for example, is the talk that includes increase in the corporate tax rate from 21% to 26.5%. That increase alone of 5 to 6% should equal to an adjustment in corporate earnings to that magnitude. Therefore, can lead to a market correction. There is talk in Washington about the increase in the capital gain tax from 20% to north of 30%. So that tax code adjustment uncertainty should also can cause a lot of market volatility and uncertainty. Markets are already discounting increase in top line earnings year over year of about 28%. So if it's already discounted in the valuations, in the event that doesn't happen, can cause additional market corrections. It is likely that the second half of the year and the last quarter of the year will start showing signs of deceleration in growth rate because it's very difficult to keep up the growth rate we saw in the first half of the year. The comparison of year over year are just getting harder and harder. These uncertainties that include second half of the year slowdown, the possibility of higher taxes, debt ceiling negotiations that will come to the forefront again at the end of the year, the possibility of higher interest rates and labor shortages as a result of potential bond tapering by the Federal Reserves that most likely can take place due to the fact that even though the labor market is not as strong as the Federal Reserve wants it to be, but it is strong enough for them to fulfill their commitment as of the last meeting to start reducing their $120 billion in bond purchases every month. The Federal Reserve, as it stands now, is buying $80 billion of treasuries on a monthly basis and $40 billion of mortgage-backed securities, mortgages, on a monthly basis. That's $120 billion, a run rate of $1.44 trillion every year of additional liquidity to support the market. But the market doesn't need as much support anymore because real estate values are up 20% year over year. And the stock market this year alone is up about 15% year over year. But with that in mind, and bond tapering starting in November 3rd of this year, markets can definitely start becoming a bit irritated. And therefore, I do think that we should all expect a market correction in the months of October. Historically, September is the worst month of the year. Going back to 1928, on average, in September, markets were down about 1% year over year. Last September, markets did not disappoint, and they were down 5% in the month of September alone. If history is of any guidance, October is known to be the most volatile month of the year, and already the month of October also is not disappointing us. We can see, and we saw already, intraday moves in the market on a daily basis of 1,000 points. Markets can easily be down 500 points and up 500 points in one day. Therefore, it won't surprise me to find out that we will end up again seeing the market correcting anywhere between 10 to 20%, which will put the market right at about the 200 days moving average on a technical selling off basis. In simple words, it can mean another 2,000 points decline for the Dow Jones Industrial Average. It can mean about 200 points decline to the S&P 500. It can mean about 1,000 points decline to the Nasdaq. We haven't had a correction of 10% or more for more than a year. Markets in general are selling 21 times next year earnings. It's not super expensive, but it's definitely not cheap. It's the nature of the market to correct occasionally. However, I do not think that this is a structural problem. All I'm thinking that, in my opinion, this is just another correction. Because fundamentally, in my opinion, the market still looks strong. The economy is still growing. We are expecting to see in the third quarter of this year a GDP growth rate in the largest economy in the world of about 5 to 6%. On a going forward basis, we still think that the US economy can grow at about 2.5 to 3% for the next few years, annually. This cannot be a terrible situation. There is also ample liquidity in the marketplace to the tune of $9 trillion. $3 trillion in money market accounts for individuals and about $6 trillion in money market and cash-like securities for corporations. That $9 trillion should provide the market with a backstop and a buying opportunity when these cash positions, hopefully, will move back into the market. Also, consumer sentiment is still at 71.3. And this week, we are expecting to see that consumer sentiment will still expand to 74.8. It's just a number that indicates that there is still confidence in the economy. And rightly so, because the total cumulative net worth of all individuals living in the US went up to $141 trillion. That includes individuals' 401k accounts, savings accounts, investment accounts, real estate holdings. This is more than double the cumulative net worth back in 2008, 2009, right after the financial collapse. That alone equals, in my opinion, higher confidence for individuals. And the last thing I want to say is that the job market is still a ways to go. But the unemployment rate is now at 4.8%. Things are getting better. We still have supply chain shortages. We still have labor shortages. But the employment numbers are getting better. It's a lot better than seeing 20 million people out of work, like we saw at the peak of the pandemic, than what it is today. My point is that with all the uncertainties and the possibility of a market correction, if it does happen, we should look at it, in my view, as just another buying opportunity. One of the areas that I'm most excited about is technology and biotechnology. The reason is these sectors are growing in astonishing growth rates. For example, in the last quarter alone, in the technology sector, Apple, Microsoft, Google, and Facebook, between all of them, managed to grow cumulatively 36% year over year. That is $330 billion in cumulative revenue only in one quarter. The technology sector is one of the most scarce growth areas in the market. It's very difficult to find companies that can still have, with $1 trillion or more in market cap, top-line growth rate of over 30%. Because of that scarcity of growth asset classes in the face of inflation, that will be another area where new liquidity should go into. There are so many good things about technology. To name a few, I will tell you that in general, technology has the least sensitivity to higher interest rates. Number one, the balance sheets of these companies, by and large, have no debt, very strong free cash flow. In fact, the free cash flow and revenue growth of these companies by far exceeds any other sector in the marketplace. Also, margins for these companies doubled more than any other sector in the marketplace in general. The labor cost to revenue for these companies is one of the lowest in the marketplace. They are innovative, they are growing. For example, Google alone is working on natural processing language with 1.6 trillion parameters, doubling every 2.5 months. By 2023, that system alone will be able to process over 100 trillion parameters. We already broke the imaging recognition mark where and when computers can look at us, understand us better than human beings, with a margin of error of only 3%. Same goes for natural processing of language. We are getting to the point that the computers will be able, most likely, to read text and convert that text to HTML language and JavaScript language. We are living through the fourth industrial revolution in technology. That includes artificial intelligence, 5G, and Internet of Things, and the metaverse, and augmented reality. These are all three super cycles combined into one. 5G alone, the fifth generation, is only in its inception, less than 3% market penetration. In the next few years, we will go up most likely to 50% market penetration. That alone is likely to provide investors with 15 times top-line revenue growth, hopefully, by 2030. Service providers and carriers that will work on communication applications for smart cities can see their top-line revenues growing at 24 times over in the next 10 years. This is why we are excited. This is why we are positioning the portfolios to be investing in companies with these type of growth prospects. We need to grow these businesses at a faster rate than inflation. We need to buy into companies that have the pricing power to pass to the consumer any increase in prices. So my look at the future is hopeful and I'm excited. I do know that market corrections will come and go, and occasionally we'll need to deal with bear markets. But at this point, I want to wish us all Happy New Year. We are getting close to the end of the year. I want us to be safe, and thank you for all your help and support.
The Federal Reserve is responsible for setting monetary policy as it relates to the setting of the Fed funds interest rate, monitoring and containing inflation, and ensuring full employment as a goal. The Fed has been very accommodative since the pandemic struck the economy, purchasing $120 billion in bonds. Of that, $80 billion in treasuries and $40 billion in mortgage-backed securities. This quantitative easing was implemented in order to keep the liquidity in the market and support the economy. The Fed has also kept interest rates at zero since March of 2020, and they're projected to remain there until early 2023, which increases consumer buying power and improves corporate profits. In addition, the jobs market is continuing to improve each month as the economy continues to reopen. The main concern now, in our view, is inflation, coupled with the inevitable tapering of ongoing bond purchases. If the coronavirus causes another slowdown in the economy, if inflation continues to rise, and the Fed begins monetary tightening, those things, or a combination thereof, could cause a sell-off in markets. Lastly, the yield curve, represented by the spread between shorter-term and longer-term interest rates, remains healthy. Of course, we will continue to monitor this for any narrowing of the curve, since that oftentimes can be a precursor to market slowdowns. Here at 911 Financial Services and Firefighters United, both a division of Tamar Securities, we attempt to accommodate these inherent risks in the market by providing 13 different disciplines with different asset allocation models. If you're in one of our stations and we've not spoken to you recently, we encourage you to reach out and arrange for a full review of your portfolio.